What if I told you that in just 6 months you could double or even triple your money? Sounds like one of those get-rich-quick schemes, doesn't it? But hear me out. When I say this, I'm not talking about risky bets or trying to ride some short-term wave. No, I'm talking about real tried-and-true strategies that have stood the test of time. These are methods I've used throughout my entire investing career. And yes, they can help you multiply your money, but it won't come without discipline and patience. Now, the first thing to understand is this. Multiplying your money is not about finding the next big thing or a magic formula. It's about understanding value. Let me explain. Back in the early days of my career, I had a mentor, Benjamin Graham, who taught me one of the most important lessons of investing. Price is what you pay, value is what you get. It's that simple. The key to multiplying your money is buying things that are undervalued by the market, assets that people are selling for less than their true worth. But here's the catch. You have to be patient. Buying undervalued. Stocks means you may not see instant returns, but when those stocks eventually catch up to their true value, that's when you see your money grow. Buying undervalued stocks means you may not see instant returns, but when those stocks eventually catch up to their true value, that's when you see your money grow. Let me tell you a story. It's about a company I invested in called Geico. Now, Geico was struggling when I first found it. People thought it was just another car insurance company, nothing special, but I saw something others didn't. I saw the value in their business model. I believed in their potential. At the time, no one else saw it, but over the years, as Geico's true value was realized, my investment multiplied, and I made billions of dollars from it. That's what value investing is all about. Understanding the worth of an asset, regardless of what others think at the time. But multiplying your money isn't just about stocks. It's also about patience, about playing the long game. Now, let's talk about one of the most important concepts in investing, compounding. Compounding is the reason why time is your best friend in investing. Let me ask you a question. If I gave you the option to take $1 million today or a penny doubled every day for 30 days, which would you choose? Most people would take the $1 million. But here's the thing, that penny, doubled every day, would turn into over 5 million by the end of 30 days. That's the power of compounding. It works slowly at first, but the longer you allow it to work, the bigger the payoff. And that's what you want to take advantage of. You want your money to work for you, and the more you let it grow, the more it grows exponentially. But let's not get ahead of ourselves. When I say it's possible to multiply your money in 6 months, I'm not talking about making a quick gamble. I'm talking about making smart, long-term investments. And yes, even in 6 months with the right strategy, you can see significant returns. Here's how. First, you need to learn to be patient and understand the business you're investing in. One of the biggest mistakes investors make is chasing after hot stocks without understanding what they're buying. I've always said, never invest in a business you can't understand. When you're looking for investments, make sure you know the company, its products, its leadership, and its potential. Don't just invest in something because it's popular right now. Make sure it's a business that will be valuable in the long run. Let me give you another example, this time about my friend Mike Tyson. Now, Mike was a heavyweight champion, a name everyone knew. But as powerful as he was in the ring, he was just as lost when it came to managing his money. At his peak, Mike made hundreds of millions of dollars, but he didn't invest wisely. He made poor decisions, didn't save, and ended up bankrupt. The moral of the story? It's not enough to make money. You have to know how to manage it and invest it wisely. Mike Tyson didn't understand the value of his money, and it slipped through his fingers. That's the danger of chasing after quick returns without the right knowledge. So if you want to multiply your money, you have to understand its value, be patient, and invest in things that will grow over time. And remember, it's not just about investing in stocks. Real estate, businesses, and other assets can be just as profitable if you know how to spot a good opportunity. The key is to always be looking for things that are undervalued, things that others might overlook, but that have the potential to provide great returns in the future. Now let's talk about risk. Every investment has some level of risk, but the risk that many people take is unnecessary risk. They're jumping into speculative investments or betting on the latest trend, hoping for a big payout. That's what leads to failure. True investors understand that risk is not something to avoid, but something to manage. You need to know your risk tolerance and only invest in things you can afford to lose. But don't be afraid to take risks if you've done your homework and if the potential reward is worth it. As I've always said, risk comes from not knowing what you're doing. But even when you do everything right, sometimes things go wrong. The market fluctuates, businesses fail, and unexpected events happen. And when that happens, it's easy to panic. But here's where patience comes in again. It's important to keep your emotions in check and not react impulsively to market changes. In fact, some of the best opportunities come from market downturns. When others are scared and selling, that's when you need to step in and buy. One of my favorite quotes is, "Be fearful when others are greedy, and greedy when others are fearful." If you can learn to act in times of fear, when others are making irrational decisions, that's when you can find the greatest opportunities. But let's talk about something else, diversification. A lot of people think that the key to growing wealth is putting all your eggs in one basket and hoping it pays off. But in reality, diversification is essential. You want to spread your investments across different sectors, industries, and asset types. This way, if one investment doesn't perform well, you have others that can help balance the risk. Diversification doesn't guarantee that you'll make a profit, but it can certainly reduce the risk of losing everything. Now, when I was young, Ben Graham taught me the first rule of investing: protect your downside. People often think the goal is to make as much money as possible, as fast as possible. But real wealth, lasting wealth, comes from not losing big, from living to fight another day. That's where diversification comes in. It's like owning a whole fleet of boats, or a portfolio of businesses, or a basket of assets. Think about the farmers during the Dust Bowl in the 1930s, the ones who planted only one crop, corn, for example. When the drought hit, they were wiped out. But those who diversified, who had cattle, some wheat, maybe even a small orchard, they struggled, but they survived. Diversification didn't make them rich overnight, but it kept them in the game. It bought them time, and time is the friend of the long-term investor. And let me tell you something about emotions. Greed and fear are the two most dangerous forces in the market. Greed makes you put everything into that one hot stock tip. Fear makes you pull out of the market entirely when things get rough. Diversification gives you balance. It tempers those emotions. When one part of your portfolio takes a hit, the others hold you steady. It's like building a table with multiple legs. One leg breaks, and the table still stands. I remember a time when I made a mistake early on. I once put too much into one stock, a small Nebraska gas company. It looked perfect on paper, but unexpected regulation came in, and the stock tanked. That was a painful lesson. After that, I never forgot to spread my bets. But let's be clear, diversification isn't about blindly buying everything you see, it's about thoughtful allocation. I like to say, keep all your eggs in a few baskets and watch those baskets closely. But for most people, especially those who aren't full-time investors, broad diversification is safety. That's why I recommend index funds for the average person. They give you exposure to hundreds, sometimes thousands of businesses with just one investment. Now take Coca-Cola, for example. I've owned Coca-Cola stock for decades. It's one of my biggest bets, sure. But even with companies like Coca-Cola, I didn't bet everything on it. I had banks, insurance, utilities, and other consumer goods in my portfolio. Why? Because no matter how much you believe in a company, unexpected things happen. Markets shift, trends change, the mighty can fall. Look at General Electric, once the darling of Wall Street, now struggling to stay afloat. Look, even when you diversify and spread your bets wisely, there's still one force quietly working behind the scenes, making all the difference over time, and that force is compounding. There's something magical about the power of compounding. Albert Einstein supposedly called it the eighth wonder of the world, and I tend to agree. But let me tell you a secret. Most people misunderstand compounding. They think it's just about money doubling over time, but it's much deeper than that. Compounding is about small, smart decisions, repeated consistently over a long period. When I started investing at 11 years old, I wasn't thinking about billions of dollars. I was just focused on planting seeds early. The first $100 you invest won't change your life. But what happens when that $100 compounds over decades? What happens when you reinvest dividends, let your winners run, and stay patient? That's where the magic lies. Let me give you an example. Imagine you invest $10,000 in a solid business that grows at 15% a year. Doesn't sound like much, right? But do nothing, just sit on it, and in 20 years, that $10,000 could turn into more than $160,000. And here's the kicker. The majority of that growth happens in the later years. That's the snowball effect. The longer it rolls, the bigger it gets. People often ask me, Warren, what's your secret to wealth? And I tell them, time. I've been investing for over 75 years. That's my edge. Most people want to get rich tomorrow. They chase get-rich-quick schemes, high-risk bets, lottery tickets, but wealth is built by playing the long game. I remember reading about a janitor, Ronald Read, who lived frugally and invested in dividend-paying stocks for decades. When he passed away, he left behind $8 million. No flashy job, no Wall Street connections, just patience and the power of compounding. Meanwhile, I've seen high-earning executives who never learned to save or invest and ended up broke. It's not about how much you make, it's about how much you keep and what you do with it. Now let's zoom out. Compounding doesn't just apply to money, it applies to knowledge. Every book you read, every hour you spend learning, compounds. That's why I read 500 pages a day. Over decades, that knowledge gives you an advantage. No one can take away. It's like Charlie Munger says, go to bed smarter than when you woke up. Same goes for habits. A small, good habit compounded over years changes your entire trajectory. Eat a little better, exercise a little more, be a little kinder, and over time, your life transforms. But the opposite is also true. Small bad habits, compounded, lead to ruin. It's like planting a tree. You don't see results overnight. You water it, nurture it, protect it, and after years, you have something that provides shade, fruit, and strength. Most people chop the tree down before it's grown because they get impatient. They want shortcuts. When people panic during market crashes, when they sell their investments at the bottom, they're chopping the tree before it bears fruit. But the disciplined ones, those who understand compounding, stay the course. That's how fortunes are made. And let me tell you, even in my 90s, I'm still compounding. Not just money, but relationships, wisdom, and the businesses I love. Compounding never stops working as long as you don't interrupt it. If you're watching this and thinking, but Warren, I'm starting late, let me remind you, it's never too late to plant the seed. The best time to start was 20 years ago, but the second best time is today. And every day you delay, you're losing valuable compound interest, not just in dollars, but in your personal growth. That's the mindset I want you to have. Think long-term. Play the infinite game. Because while others burn out chasing quick wins, you'll be quietly building a legacy.